Hello, everybody. My name is Nina Seega. I lead the Center for Sustainable Finance at the Cambridge Institute for Sustainability Leadership. And I have an absolutely fantastic panel here today talking about adaptation, resilience, and physical risk. So let me briefly introduce the panel. I've got Professor Dame Angela McLean, UK Government Chief Scientific Advisor, Government Office for Science. I've got Claudia Prates, Director of Sustainability, CNseg. We've got Svenja Surminski, Managing Director, Climate and Sustainability, Marsh, and Meryam Omi, who's the Chief Executive of the ARC. So we have some really interesting questions to get through, and rather than starting as it usually does around the barriers to resilience or the barriers to physical risk, let's start a little bit talking about what's already happening. So where's better climate risk intelligence already improving real decisions and driving adaptation finance to flow at the scale required? So if I start with Svenja, maybe on that one.
Okay, well, thank you so much, and it's a pleasure to be here. Yeah, I think it's useful to start with, what is already working. I struggle a little bit with the term risk intelligence, because I think that's actually a really important point. So often people in this space think about physical risk and assessing it. And I guess that's where we've seen biggest progress. So we have really good tools, we have really good models, we know how to do that. At Marsh, when we do surveys, a large number of our clients have actually done that, and we work with them on that. But I think that, to me, is not necessarily risk intelligence, because it matters what you then do with that. So how do you then translate that into bankable projects, into investable initiatives, into real action? I think we're seeing progress. So again, it's kind of quantifying, prioritizing where adaptation works, often in the context of real assets. So, the assets that you own, the assets that you manage. That's where we see, I think, driven often by loss experience, unfortunately, but we see a recognition, look, we're just not built for this climate, so we need to do something. I think where this is really becoming a challenge, and that's becoming more and more evident, is where we're leaving the assets and looking at the system, and sort of having risk data and then risk intelligence that looks at the system and the system's risk, supply chain, infrastructure dependency. So I think that's kind of where I think it's really important that we push harder, we work, with modelings, with tools. But just to give you two examples, so one is in the private sector. So in the insurance context, where we've placed a big resilience bond in North Carolina. So that started with the tools, the bread and butter tool of assessing risk, and then linking it to a program called Fortified Roofs. So actually, the whole mechanism with insurers, with capital markets, is geared towards funding fortified roofs, which in turn reduces the loss going forward. Really good example. The other, and that's the next example, because a lot of this also plays out in the public sector. So I sit on the UK Climate Change Committee, and some of you might have seen our well-adapted UK report that we published a couple of weeks ago. And that's an example of really utilizing data, but not stopping at the risk data, but then looking at the economics. So we've costed what it actually takes to make the country well adapted. And then we've also really sort of looked at different options and different targets. And I think that's kind of, if you want to make something risk intelligence, you need to know where you're going. And with adaptation, that's sometimes less clear, I think. So very happy to discuss that. But I think we'll see progress, but it's really about implementing that good information and the data that we have.
Thank you so much. And then coming to Claudia, what do you see as good examples on the ground in Brazil?
In Brazil, thank you very much. I'm very glad to be here, and also very glad that adaptation is being under discussion in this London Climate Action Week in a heat wave, and with insurance sector discussing that. We have here Sonja, myself. So it's important to look for the insurance sector as a prevention, as a helper with data. As Sonja said, we have several examples that we can say that the insurance sector can help beforehand to build resilient infrastructure, resilient assets in general, and also protect social vulnerable people, so the social impact that we have. So complementing Sonja, I would like to say that Brazil has developed a lot with data. We have like insurance sector with lots of data, government providing data, but the point is to convert this in financial decisions and attract capital for adaptation. This is the trigger point. So let's give 3 examples as well. For rural and agriculture, we can say that we have monitoring satellites, we have drought alerts, we have lots of data going on, especially for bankers. We have a very good institution in Brazil like called Embrapa, the insurance sector, but we have like only 5% of our cultivated land insured. So we have the climate consequences and no insurance to bring new money. So we have lots of problems with that. The resilience of the economy begins like undermining because we don't have new money coming. We have to reinvest in projects, do refinancing. So the rural, we have data, but we are converting in some more resilient investments, but no insurance at all. The second example I would like to mention is in the energy sector. Our matrix is dependent on hydrology. So we have our institutions are looking for that and the intelligence is there, but we have to finance resilience in the sector as well. And the other one is urban resilience. We have alerts, we have sensors that says in some municipalities that invest on that, but we have to scale up. It's just the beginning. And we have no insurance for municipalities and governments there, especially for catastrophe bonds and etc. And Brazil is facing severe and frequent events that are causing some damages in the budget of the government and also in our economy.
So thank you actually for bringing the insurance protection gap into this conversation. I think we'll talk about it a little bit. And also talking about this common architecture and climate risk analysis, so the analytics bit. And I'm going to bring Meryam here a little bit because you've just had an announcement recently. So maybe talk us through some of the thinking around the common risk architecture and the competing services versus shared.
Thanks, Nina. Yeah, so I'm going to get to what we launched, which is Resilience Arc in a second, but I want to kind of deduce everything down to interoperability, because we can talk about big common architecture and infrastructure for this, but we have to get going. We don't have time to build a perfect infrastructure, but what we have to absolutely build is interoperability. If you're sitting on great data, but it's not connected to anything else, even if it's sitting in an insurance company, that is not going to build a resilient world. So today we have geospatial data, location-specific data. That's changing all the time. So we have to be able to compare and contrast different type of data sources. We also have lots of scenarios of weather impacts. Now, I don't know how many of you looked at different weather forecasts. Is it going to be 32 degrees? Is it 37 degrees? You know, you're still kind of arbitrating between different sources. So we need to be able to do that because we don't have perfect accuracy when it comes to weather. So being able to compare and contrast different data sources, whether you have publicly and openly available data or commercial data, it doesn't matter. The only way to get better is to share this kind of data sources. And then coming on to what we build, which hopefully is going to be some of that platform, is we have physical risk data with information on what to do about it. These things need to connect. Most of what's been built is what risks are we sitting on? What kind of risks are we going to have? Very little, and what are you going to do about it? And give you an example of the insurance. I was talking to some Asian companies who said they were very much impacted by a lot of weather impacts, whether it be floods or droughts. but there was so much insurance in the market, the premium wasn't actually impacting what they were paying. And so what we have to do is really combine, again, what's happening in the world to how are companies building resilient business plans, CapEx plans. What infrastructure do they have? How are they connected? What kind of relationship do they have with their supply chains? All of that requires interoperability, something that we've been working on the climate emissions data for a while, although we haven't quite achieved it yet, but something we have to rapidly build as a common good.
Angela, can I bring you in on this point as well?
Absolutely. Meryam has put it very, very well, and I'm going to struggle not to say the same thing, but in perhaps easier words, because I'm not in the insurance industry. But I am a mathematical modeler, I'm a mathematical biologist, so we also share these issues about transparency and repeatability. I come from the academic world, so we have different norms, but fundamentally what we need, the situation we need to be in, is that if we run several models to explore the same event, when they give different answers, we'd like to know why. That does not require people to reveal what's going on inside their commercial model. I think, actually I think the commercial incentive to build these sophisticated models is a marvelous thing. But I think we do need more of the kinds of studies that say, right, here's an event, here's a bunch of, let's say, exposed assets, what happens? And it turns out you get very, very different answers. Now, there are several possible reasons for that. One, they've actually used different inputs. So my understanding is that in that study, actually, people had different understandings, actually physically where the assets were. And that's something that we ought to be able to iron out, because physically an asset, at least at a given point in time, is in a place. Not much uncertainty there. Then that might be that you're describing outputs in a different way. And that we ought to be able, again, we ought to be able to iron that out. We ought to have enough transparency that we can say, are these two things really different? Or are they just describing the same thing in different language? And then what's in the black box? I don't want you to all show me what's in your black box, but I would like you to be able to have a conversation about, well, okay, so we put in exactly the same inputs and we get actually real different outputs. That means that there's some assumption in here that we made differently. And actually there's really interesting, sort of what I would think of as scientific information in there. Why do two very competent organizations make different assumptions about what would happen at this event, and what do we need to find out in order to iron that out? So I'm taking a pretty scientific approach to this. I want transparency, not full transparency, but I want transparency about, for a given set of inputs, what are your outputs? And I want repeatability in the sense that I don't need the same answer, but frankly, I need the confidence intervals to overlap. Otherwise, there's something very odd going on, and there's something deep down in there that we don't understand enough, and we need to find it out.
And if there are differing assumptions that are currently being done in the market, then that does not bode well for that market going through events. Svenja, did you want to come in here?
Yeah, just briefly. I mean, I think there has been a really interesting evolution where actually the knowledge and the tools and the models have become also competitive tools, and so not just in the insurance sector but elsewhere as well. So the better data you have, the better you understand, the better you can analyze. This is a competitive advantage, and these things also cost a lot of money, so it's a significant investment, and I think that has in the past often been the barrier to then sort of make it available more freely and share it. So I think we need to keep that in mind. But the one key point that is really still hard is, as I said, we are good and we're getting better at identifying the risk, and we even have the climate change projections. But many, many, many models ignore adaptation levels when they assess that. Or they have assumptions like, zero adaptation, full adaptation, but that's not good enough to actually then reward resilience for someone who has invested in it.
That actually brings me beautifully to my next point. Thank you, Svenja. So at CISL, we published a piece of work at the end of May on resilience-adjusted credit rating. So essentially, how can banks and financial institutions start incorporating resilience into it? And that looks at things like physical risks, at things like insurability, but also things like avoided losses. Because right now, if they're taking a loan to improve their resilience, their loan to value goes up, and there is nothing on the other side to help. So let's just stay a little bit here on the opportunities to incorporate next generation risk, so tipping points, cascading things into financial models. So if I start maybe with Meryam here.
Yeah, so a lot of the risks so far have focused on direct risks, so how it impacts a plant, a farm, a building, which is very important, and all of that work needs to be laid over. But one of the things that we are definitely underestimating is the indirect risks and the sort of next generation risk. So to give you one example, I was, in my previous life as an investor, I talked to lots of different companies. We would say, what is your physical risk? And they would describe water availability, too much, too little. But actually how it was impacting was how it was having a social license to operate in the local community. That's what mattered in terms of business operations. We also had situations like the Panama Canal in 2023, which had to shut down because of drought. Now, it seems like a one locational issue, but you can imagine how much commodities are passing through the canal. How many of the businesses are impacted by that one shock event? And we have to think about that. So I would say when it comes to resilience, much more than transition risks, it really has to be that the problem might be localized, but the solutions has to be community driven, which means that the information about the direct and indirect impact has to go in the hands of back down to the plant and the farm, but it's city, it's insurer, it's banker, it's government, because maybe the current regulations, the current policies are actually not helping them to move towards a solution. If you are downstream from a river and you keep getting flooded, there's not much you can do. You have to move. You can't insure yourself out of that problem. And so I think one of the things we have to build is the financing solution is not an individual problem, something that we have to collectively build. And that's really difficult when you own a farm and there's nothing you can do about it. So I think the data that we're collecting has to be to build those decision-leading solutions.
And actually, if I bring Angela in on this exact
I completely agree, and let me name them as systems level understanding. And that is what engineers are trained to do. So I mean, let's bring the engineers into these discussions. Let me give my favorite example of a cascading risk, because these naughty risks don't just sit in their own sectors, do they? So the last time we had a 40-degree day in the UK, so that was July of 2022, 2 London hospitals had to shut. They didn't have to shut because it was too hot inside the hospital. They had to shut because a data center in Slough had to close, and that data center was managing all their information. So they just couldn't operate because of an event, that would be 25 miles away. And I think that's a fantastic concrete example of exactly what Meryam's talking about, that we need to have a systems level understanding, which is quite a big ask, actually, of what our exposure and vulnerability are to these sorts of events. But it's not impossible. These are engineered systems. They're actually, they can be described. I'm not asking you to understand how the brain works. It's an important part of the work that we need to do. And I think Meryam's already beautifully explained that we need this thing that I would call a systems level understanding of how the risks are interconnected.
And actually, when we talk about systems level understanding, we usually talk about collaboration to think through it. So that, again, it's an important point. So how do we get governments, insurers and investors and lenders as well to work together to support resilience and insurability? I mean, we launched yesterday, I'm sorry I'm doing this, but otherwise my team will never let me go on a panel again if I don't plug the stuff that they're wonderfully doing. So we launched yesterday something called an insurability readiness matrix that essentially brings insurers together with corporates and banks to talk about that. But essentially kind of where are those collaborations? How can we get them to work? So if I go first to Svenja.
Yeah, I mean, I think one thing that has clearly changed is that this is no longer a conversation that happens somewhere between, an underwriter and someone who's at risk. This has become a more sort of systems approach. And I think you can see this here at London Climate Action Week. I mean, I've spoken at lots of events where we had investors, where we have asset owners, asset managers, where we had insurers in the room, talking about this, how the real economy and the financial sector can kind of get grasp of it. I think, again, where this works is often very context specific and geographic specific, because I guess, we throw out adaptation. I mean, adaptation is so multifaceted. So if we're talking about this in the context of, let's say, countries in the Caribbean or in Africa, where we have these risk pools that were designed, which are actually a result of that collaboration between governments, between industry, and between experts, who also sort of as an incentive to reduce risk, your participation in these risk pools, these risk transfer pools, is actually becoming more, becoming easier to participate. So that's one thing that works in that context. What works in the context of corporates? I think, there you have now sort of initiatives where, companies that operate in the same business park, again, sort of like this idea of being place-based, so recognizing I can do stuff to protect my own assets, but I still need my employees, my clients to come to my facility, or I need to have access to infrastructure. And if someone else in my neighborhood doesn't play ball, that might also have negative implications. I think that's starting to sink in, and we have these sort of partnership approaches where you then say, okay, let's see if we pool together and make a joint investment. And we're working on this here in the UK. We have a couple of projects where I think as people see the evidence and see the benefits that this can generate, they then pool together and kind of jointly invest. And I think that's promising. It takes time. That's one of the challenges. It takes time and it takes trust. Trust not just in the data, but also that these things work. And maybe we should be careful. I mean, adaptation and resilience is sometimes really hard to measure. And sometimes you actually only find out if something works well after an event, right? So, for example, with nature-based solutions, like I'm a really big fan, and we need to do more of that. But we also need to have the confidence that it actually does what we're hoping it does. So more evidence and trust is really important.
And I guess for that, independent verification is always helpful. Just coming to Claudia here, talk to us about kind of where do you see this collaboration coming in?
Yeah, I'm not going to repeat Sonja, that she made a very good response, but it's important to mention that government has to have public data. And Meryam mentioned about licenses. I think that the assessment of risk of the assets beforehand, like the government showing where the risks are, and then to issue a license, so you have to do that and that to have a more resilient asset. But I agree, we can't ask business to only protect themselves without the municipality doing their job, and also the tail risk being assumed by the government, because catastrophe risk is not for the private sector. It has to be divided, so you have to have the collaboration. So, and also a question that I think was in the beginning of the panel, how to attract the flow of money for adaptation. Is hard because we talk lots about mitigation, about net zero, about how to, okay, it's very important, but we have to do things at the same time because our assets are not protected. Our municipality needs to be more investment in adaptation, to prepare for business, to prepare for social impacts of the climate change. So I think that everybody has to work together, bringing data, but converting it to decisions of investment, banks looking at that, and especially I want to jump up in a question here about the ratings of municipalities, of governments, and also sovereign risk ratings. Yesterday I heard that Jamaica had an upgrade because of they have like catastrophe risk bond to cover them in catastrophe. So they gave us like a notch of upgrade. It will be a good measure for countries if they invest in adaptation, also municipalities, etc. If they have like an upgrade, how resilient they are, like a measure of that, and then you have an impact in their rating. for companies, governments, and everybody, I think money talks. If you have a reducing your spread risk, this will bring money.
Absolutely. So I have one more question for the panel, but I'm giving a warning to the audience that I'm going to open up to questions from the audience. So if I see people leaving, I will be glaring at them. So think of the questions. But one question that I still have for, I think, every single member of this panel is, what is if you could prioritize one near-term intervention, what would it be? Like, what would be the one thing that you either want practitioners to do today to really move the dial here? So I'll go back through, starting with Claudia.
Okay. For me, the call of action is start looking for climate risk as a financial risk, a social risk. If you look at, it's not like an environmental issue, it's a financial risk and social risk. So you have to convert the data in information for that and invest on that and think of that. So money talks. So this is a good point.
Financial materiality. Angela.
Mine would be to think about this as an opportunity as well. So in our analyses, we reckon there's 150 billion to 350 billion of new business in climate adaptation for the UK. Most of that lies in either engineering here onshore or reinsurance for the world. Those are both things we're extremely good at as a country, and we ought to be going after them pretty hard and fast. So I would then say, think of it as an opportunity, think of it as an imperative, and don't forget that this is the thing that we have to do as well as not zero. It's an and, not an instead of.
Meryam?
I also have to do my team justice in having launched Resilience Arc. So we've built a public platform that has a lot of physical risk data and a methodology of assessing resilience at the corporate level. The only way to get better is if we can share it with you. It's public, it's philanthropically funded, it's available to share. So are you sitting on data? Can we share it? Do you have a methodology that's better? Can we share? So it's a really open call to contact us to make it better. Even if it's behind a paywall that you have, that's fine. We can still share the underlying data to make each other better. So that's a call for action for you.
But I'm going to help your team. Who are we talking about? Corporates, financiers?
Anybody who's reading on physical data and resilience measures.
Fantastic. Svenja?
Well, the first thing is, I guess, to really treat physical climate risk as a financial issue. It's not, it is material, and, we have the tools and to assess it and to understand where it is material today and how that's likely to increase elsewhere. That's really important. So I think going into investment committees, going into boards, going into procurement questions, where physical risk feature, I think that is the absolute prudent thing to do. And then, if I may, a second one is be smart about resilience. We heard this morning a lot about mitigation, and let's not forget that is absolutely essential because, mitigation, reducing emissions is all about, sort of avoiding the really unmanageable, the catastrophic thing. But we can do both together. And that's where actually the co-benefits and the economic efficiency is biggest. So if we go in and design homes in a way that they're energy efficient and climate resilient, wouldn't that be great? If we place new infrastructure for the energy system somewhere where it's actually solid and it's not gonna sort of fall into the ocean or get flooded or be subject to drought, wouldn't that be great? I'm sort of saying that a bit like tongue-in-cheek, because as you can imagine, we are unfortunately not doing that to the extent that we should. And that's the problem. We're actually creating new risks rather than reducing the risk. And actually, that's really important. And with adaptation and mitigation, we need to have both. That's really essential. And we can do both. We need to link them together.
Or if you're doing something super popular like financing or insuring a data center, have a look at the water scarcity in the area where it's being placed so that you don't end up with a stranded asset. Okay, now you have been prepared. You know this. Okay, fantastic. I have hands coming up. Brilliant. I've got roving mic. So I'll take a couple of questions in one go. So there's a gentleman on the left and then a gentleman on the right. And then ladies, I'm expecting you also to ask questions.
Thank you for the panel. I'm Christian Lalong from Bloomberg. And I have a question about the spending in adaptation. With the EU taxonomy, we can see how companies are spending their capital and the revenue. And the mix so far has been 98% mitigation, 2% adaptation, and peanuts for everything else. Is 2% the right number? What do you think the right number should be in revenue and capex for adaptation?
Wonderful. And then I'll take that question over there as well. And then we'll answer a couple, and then we'll go for another round.
Thank you. Really interesting panel. Andy from Worley. Worley are a global EPC. It's in part our role to build resilience into the assets that we design and build. My question is about governments and their language around resilience. You obviously see when it comes to budget cycles, they're talking about new investments, they're talking about new assets they're building. You never really hear them talk about reinvestment into assets to build extra resilience. You might do after there's been a crisis and something's fallen apart, but you don't really on a cyclical basis. In terms of trying to embed this mantra into the private sector, what more could government do within their language to talk about resilience?
Okay, fabulous. So how much is good enough, and what would the government do? I'm looking at Angela.
Svenja, am I right in thinking 11 billion a year? You said to us in Adaptive UK.
The CCC is 11 billion. A year.
Sorry, I don't know how to do the comparison. I only have that one number in my head. Forgive me. But I mean, the Well Adapted UK report has done us a great favour in government and given us a sort of sighting shot of how much you're going to need to be spending. And I think that 11 is sort of half and half government and half and half government and private sector. So I did just want to say how lucky we are, I think, to have the Climate Change Committee as an independent voice to tell us what we need to do. And the way this recent report has been written is really a pretty clear imperative. I can tell you it's gone down well, actually, from a set of, I mean, you'd have to be, I mean, especially today, you know, you can't bury your head and say this isn't happening anymore. You really can't. You know, you can't bury your head and say this isn't happening anymore. You really can't. So that's it's been very helpful. So thank you, Svenja. That was one question. What was the second question?
How would government help investment in resilient infrastructure and making sure that the private sectors help to do that, right?
So I think the good thing to do perhaps would be for government to take the Climate Change Committee's very clear steer and set an objective, set a target. Climate Change told us they've told us to aim for a climate that is at 2 degrees centigrade in 2050. I mean, they've just been completely clear with that. And let me tell you, clarity is extremely helpful. So that would seem to me would be a very, what do we mean by starting to get adapted? It would be great if the UK government were to take that very clear advice we've had.
Can I, sorry, you go.
Well, very briefly, I mean, certainty is one thing. So investors need to know where we're heading, how much government is actually doing, what government is doing, because it needs, you know, you need to understand what falls on what side, and we haven't had that clarity. So that's really, that kind of consistent signal is important. And to come to your question, I don't think there is a fixed number, because it's very specific to the sector you're in, you know, where you're located, what you're doing. And I think we do this a lot across various businesses, and you start with, you know, sort of unpacking the visible risk and the invisible risk. And then you're looking at, okay, what are your investment plans anyway? And where are the low-hanging fruits, if you like? And some of that might not actually feature as adaptation investment, but if you design it in, to me, that's actually good enough, right? And that might not feature as, oh, here's our big, shiny adaptation investment. So I don't think I can give you a number. Two sounds very low, I have to say. But I think it's very specific to where you look.
Yeah, I just wanted to come in on what can the government do in terms of, well, there is an actual amount that you can put in, but there is a lot of regulations, building codes, efficiency measures. There's a huge amount of interventions that governments had. So we have talked a lot about kind of efficiency score of a building or something. I don't know, when you bought a house, you looked at your flood risk of your area. That's publicly available. By the way, most of London was kind of potentially if the Thames barrier goes, like we're kind of not in a good place. But we haven't actually gone further into what that really means, because we don't have, if you're buying a house in London, you're buying a house in London, so you don't really have that choice. So what are the measures that governments can put in, and how secure do we feel about the barrier that we have in London? I think there is that kind of thing that goes beyond the amount. And the other thing is, it might be 2%, but there's a lot maybe in the 98% that could build resilience. The way we build today for transitioning clean solutions have to be resilient. What's the point of a solar panels in a floodplain? Things like that. So I think to your point about the interaction, let's not see adaptation as a siloed subject. How does it penetrate into the existing policies and regulations, and the way we're allocating capital is far more important than impactful.
Did you want to come back?
I just wanted to come back on the Thames barrier, because I'm so glad you brought it up. It's one of my favourite bits of resilience infrastructure. If you've never seen it, go and see it. It is a beautiful object. We know that it won't last. Plans are already underway to replace it in 2100, by which time it will no longer, it would get topped then. Those analyses are in hand. There will be a competition. It will have to be rebuilt. It'll be much more difficult to build the next one, of course, because you have to think about the edges. But I think that's it's a great example of trying to get ahead. I used to think that the Thames Barrier was a brilliant piece of anticipatory adaptation until I read about its history. And of course, actually, it was built in response to a devastating flood. So sadly not. I mean, and I think that's one of the things, perhaps another thing that we should all push for is don't wait for people to die. We have to build this stuff now because we know what's coming.
Claudia, do you want to
Yeah, I'm talking about government in the perspective of Brazil. New concessions, they are not, there was a study that for the last 20-something concessions, only 5 were considering climate risks in the new concession, so it's very low. And in my opinion, to induce concessions, to evaluate the adaptation, how they are adapt, maybe you can postpone the concession, give some incentives for them to invest on that. So to be a good form to a pathway to go. And regarding the number, I don't have the number as well, and I agree with what Sonja said, but I think that they have to assess their assets, see the risk they are facing, and do a cash flow, what will happen with their cash flow if something happens there. This is a good way to move the investment to the right adaptation way, and I agree that you have some new investments in private sector looking for the adaptation needed.
And you can also have a look at what happens if your insurance gets taken away, because that's also a useful metric to understand. And I think just maybe on that question, it's interesting. There's one of the reasons I really don't like single targets, because that it induces the financial system to optimize really unhelpfully for one against the other. So I think differentiated targets between adaptation and mitigation are quite helpful. Okay, another round of questions. There's a gentleman right there at the back. And there's, yeah.
So just a quick question about, the government, potential change. If the, government change and the policy could be changed, or, actually I should ask this question in the last section, but she left, so I leave this question to you guys. Or you think the policy will keep consistent, in this area?
And then a question over there on the left, Rocky.
Hi, my question really is around, we haven't really talked about the role of the end user. I know you just brought up something on flood and recognizing flood, but I'm Raki Kumar from Liberty Mutual. We've been doing a lot of work in the US on this topic, and the US government actually has funded this BRIC programs, and it's really interesting because it's bringing, in order to get access to it, communities and states have to put their own money up. So there is part of that. There are 2 issues. One is it still needs the end consumer to make the right choices and reward the system. And we still see people buying homes in or they don't want to actually know the risk because that's too scary, right? That's the first one. The second one is if a consumer is given a choice of spending $10,000 on a granite countertop or replacing their roof, guess which one they're going to make? Most of them, okay? So this is how do you crack that nut, and should we be honest with the end consumer that all resiliency is going to cost the end citizen? We didn't do that in mitigation, and should we be doing that in adaptation?
Okay, so we have a policy question, which is, to be fairly honest, your guess is probably as good as ours, given what's happening. So I think we can park that one. But the question on the end consumers is really interesting. So how do we drive demand? What do we see in terms of moving that? Svenja, you were looking like you were about to jump in.
Well, it's a very good point, because actually a lot of solutions and innovation and pilots often struggle to fail to scale because the uptake and the demand isn't there. And that applies to insurance, that applies to some resilience measures. And I think it's a really clear question, like who pays when, to what extent does there need to be transparency? I think definitely a transparency in terms of where we're heading. I think the risk, often people still are not quite clear that things won't repeat themselves. I mean, there's this famous saying, you live in a 1 in 100th year flood zone. Well, you had a flood and you're safe for the next 99 years. I mean, we're smiling, but, sometimes we have failed to communicate things correctly. And just to reiterate that, I think it's also a job for government and for politicians. So 81% of the UK's population, across party lines, across affiliations, feel the country is not prepared for a changing climate. That's quite significant. I mean, that is like an instruction to do something about it. I'm sure these people would not like to be told that actually it's going to cost them more to adapt. But we need to also be transparent, and we need to say, look, there are some investments that others will do, but there's also something that will sit with us as individuals, I think. I mean, climate change is unfortunately a costly business.
Angela?
It would seem to me that the insurance industry could help here. Because if you think about insurance is a market mechanism for us to share risk. And it would be a great thing if, in the same way as I can pay less insurance if I have proper locks on my door, if I could pay less insurance if I had taken my climate resilience more seriously. My understanding is that that's not yet really strongly in place. And that will be a good incentive, first of all, to get people to make the changes, and also for people to have some understanding of what it is that we are all facing here, going to have to do.
But also, I mean, if we come back to the very start of this conversation, right, we were talking about different assumptions in the market, right? And I think the big question around the demand is who takes the risk? Because if we're talking about property level, the property gets hit, the first risk is taken by insurance, the insurance withdraws, the second risk is taken by the bank. Then what happens then? When are people affected, and when is the government being drawn in? So it is better communication about who carries the risk under which time frame, and how can we invest into resilience to mitigate that for everyone involved is important. I think I've got a red blinking light that's going at me, which is, I'm assuming, is an indication that however much we have all enjoyed listening to our wonderful panel, the time for all of us to have lunch is coming near. So may I ask for two things? One is to say a huge thank you to my wonderful panel for their fantastic views. And second, to proceed to lunch. And I understand we need to be back at about 1:45. Is that right?
Yes, that's correct. So lunch will be served in the Egyptian hall that's right through these doors. You can also use the north drawing room, which is to your right there. So please enjoy lunch.